connections to SDG 1, which is no poverty, zero poverty, and SDG 17, partnerships for the goal. This panel will explore how tokenized assets can expand access to markets, lower transaction costs, and foster transparency, particularly for underserved communities. So moderating the discussion is Yvette Valdez, partner at Latham and Watkins. She's joined by a distinguished panel of Rajeev Bamra of Moody's Rating. We also have Sarah Hammer of the Wharton School, Jason Lau of Ox, and Manoj Ramia of Digital Asset. Welcome them to the floor. Thank you.
Thanks. Thank you. So thanks everyone for joining. I think we have a pretty interesting conversation, and we could definitely talk for much longer than half hour, but we will limit the discussion. Tokenization has certainly been a buzzword for a while, but there's particular parts of the financial markets that are really being transformed currently. So maybe I'll start off the question to the panel is, what's real today in terms of tokenization? What's the potential and the possibility, and what's hype? And maybe we'll start with Jason.
Oh, cool. Yeah, hi everyone. I'm Jason. I'm Chief Innovation Officer at OKX. We're a large global crypto exchange and platform. We provide trading and wallet and self-custodial services to users globally, institutions and retail. And so to answer your question, from where we stand, stablecoins have been and continue to be sort of that forefront in the push for tokenization, right? This is taking dollars and putting it on chain, allowing anyone to use it without many of the barriers or access issues that people may face. So we're building a lot of products around that primitive, basically, making sure users around the world have access easily to convert from their local currency, for example, but also to earn, say, yield, for example, on top of those digital dollars that they hold. And I'll pause there quickly. Yeah.
Sarah, I believe you wanted to layer on.
Oh, thank you. I want to start by saying thank you to you, Yvette, for moderating this discussion. And I want to say thank you to Sandra Rowe, who's sitting in the back, who I've known for a while and am really grateful to have the opportunity to be here today, and all the great folks at GBBC. This is an incredible event, and it's been going on for years, and I'm just pleased to be a part of it. I'm Sarah Hammer. I'm previously of the Wharton School. I was Executive Director for Strategic Initiatives there, and CEO of our Emerging Technology Accelerator, which was focused on blockchain and artificial intelligence and quantum computing. I'm now Managing Director at Charles Schwab, where I head trading, digital assets, and artificial intelligence compliance for the firm. But I'll have to caveat by saying my views are my own and not those of my employer. So I just wanted to, I'll be as brief as possible. I know we have a lot to get to in today's discussion, but I've had the privilege of working with the UN and the International Telecommunications Union, which houses AI for Good and is very focused on the SDGs. I sat on the board there for 5 years. And I've also had the privilege of working with companies that are using tokenization for sustainable purposes. And when I say that, I mean tokenized forms of healthcare data so that folks can port their individual information safely, securely, and more efficiently, using tokens actually to port energy information to increase efficiency, and of course, stable coins and cross-border payments. And I'll just add that in my experience, I was astounded to learn that the transaction cost for many folks who have to send money home overseas can be upwards of 30, 50%. And that is just devastating for folks who really need to get those funds home. So tokenization is real in many ways, but when we get deeper into the discussion about the interoperability and the operational constraints that we have, I think it's an important conversation to have as we think about what tokenization will mean going forward.
I think the use cases you just raised preliminarily are actually about providing access, right? Providing access and democratizing access. What are the use cases that potentially continue to be aspirational, and where are we trying to get to?
So you're asking me, right, Yvette? I don't want to speak for my colleagues. I mean, tokenization can be very useful in some cases. So I mentioned the use cases in healthcare, for example, and certainly there are a lot of issues in healthcare related to access and cost, and using tokenization for things like porting data, for example, or even supply chain management for surgical devices, which I've seen that in my experience running the accelerator, can help reduce cost overall in the system and provide access for folks that need it. I think going forward, there's a lot of work to be done on how we can actually implement some of the use cases that we think about, right? So how do we expand the use of tokenization and porting information and making supply chain and things like healthcare, for example, more efficient? And I think there's operational work to do in that respect. I think there's interoperability work. Everyone here is probably thinking about what's happening in the news with companies issuing more tokenized stocks and tokenizing their own equity and all of the regulatory issues that need to be discussed around that. And I think just to give a really small example, I could tokenize, like suppose I want to tokenize some data from the United Nations. So I have a piece of data that I want to tokenize so that I can put it on blockchain, I memorialize it, I want to use it for different things, I want to port it securely and enjoy the immutability of the blockchain. But someone else can purport to actually tokenize the same data. Just like if I tokenize an Apple stock and Apple actually tokenizes their own stock, that actually means two different things. And a lot of it goes to what are you actually promising when you create that digital asset? What do the legal documents say? What are you representing? And what are you holding in custody? Is it data? Is it the data that you need? Are you the owner of that data, for example? Do you have the stock in custody? These are questions that I know the GBBC is working on. And I think taking a look at their risk management principles, which came out recently, could be really useful. But I believe we have a lot of work to do in that respect.
You raise some good points, I think, with the tokenization of Apple stock example, for instance. And I want to ask Rajeev and Manoj to weigh in here. You know, there's a lot of focus right now in sort of the introduction of new risks and what that could mean, and also the overlay of regulation and how we sort of deal with it. If tokenization becomes widespread, what are the new risks that we're introducing into the system that then we're going to have to grapple with?
Sure. So as Rajeev Bamra, I oversee the global strategy and operations for digital economy at Moody's Ratings. Basically, my job is to help Moody's do what we do in the conventional world and replicate that in the digital world by using our methodologies, frameworks, and risk models. So I would start by saying, which I always try and say at every panel, is we strongly believe that an asset, that credit is credit and bond is bond, right? What is actually changing is the tokenization aspect or the digitalization aspect of the assets and the way they are being digitized and wrapped into those tokens. That's very important to understand. So what tokenization is doing, it's not getting rid of existing risks. It's just reshaping those risks as well as introducing new unknown risks. And those risks are, I can think of operational risk, for example. So we are adding layers of process like minting, burning, on-chain settlement, on-chain payments, for example. And it's very important to understand how that is going to have an impact on the asset life cycle or the credit life cycle of the asset. The other one can be considered as cyber risks. So smart contracts, bridges, wallets, vaults, they all introduce new forms of cyber risks and are very easy vectors for cyber attackers to actually go after and low-hanging fruits for those cases. So it's important to understand the integration and the interoperability between participants offering those services, as well as do the due diligence in terms of auditing and related assurance services, so kind of activities. The other thing I can think of is custodians or custodial risks. In the traditional world, we have a very well-defined custody value chain. In the digital world, we still don't have that, especially if we talk about token native issuances. And it's very important to understand whether the key management policies and processes, as well as the required cyber-related policies and processes are active and can actually handle any attack that may happen on the wallet. So if a custodian goes down, or if there is a smart contract violation, who is liable for the asset that may be attacked or lost? It's very important from a credit ratings perspective or final risk assessment perspective to understand that aspect. And I will wrap it up by adding one more, which is we generally bucket it as external risks, but it covers legal regulations, any third-party risk management related efforts, which is also important because in our view, laws are still catching up. So the example I use, smart contract exploits, who is responsible if something goes wrong and the asset is lost or the token is lost? Is it the exchange? Is it the custodian, or is it the developer? So it's very important for us to understand who will be liable for the promise that a credit rating agency like Moody's is expected to actually assess and put out a rating. So these are the aspects that we've been trying to work on and research on by building key risk indicators. And this is in addition to the known risks that I mentioned earlier that our methodologies and our frameworks already cover. And that's why we've been able to rate digital bonds, tokenized funds. We are talking to stablecoin issuers to understand how they're structured. There's a need to know the market value risk as soon as you talk about crypto assets because of the volatile nature they bring to the table, which is also a new form of risk, which is very high and exponential compared to those in the traditional world. So I'll just pause there, and I'm sure Manoj has more to add.
Yeah, and maybe to jump off on that last point about legal risk, I think what we're seeing is this nomenclature problem, even within tokenization of things like stocks, where you have people that are saying that they're tokenizing a stock, where what they're doing is creating some sort of special purpose vehicle, buying the equity in that vehicle, then issuing a token against that vehicle, versus an alternative where the token is actually, what you think of a token is something that is, the holder has the same legal rights against the issuer that the holder of a non-tokenized stock would. So you've got these two different instruments out there under the same name that I think is causing a lot of market confusion. And I think there are very real regulatory and policy concerns, especially when you have people that are, ad hoc tokenizing things on their own without the permission of the issuer, versus a proper process where you're actually able to bring the sort of the books and records for that instrument onto a blockchain. And I think that latter approach is really where you're going to see a lot of the benefits, where you're really getting everyone to the same place in terms of technology. You're having the data that's actually able to synchronize. And for quick background, so I'm the general counsel of Digital Asset. We created the Canton Network. And about a month or 6 weeks ago, there was a press release put out where a number of participants in our network used what you would call a tokenized treasury or an on-chain treasury that was used in a repo transaction on a Saturday afternoon settled against USDC. So there you see a very tangible benefit of something that you just can't do today. It was off hours. It was settled instantly because it was on a blockchain using USDC. And there's a very real benefit that, in the abstract is sort of this esoteric thing, but you think about it, on an accretive basis of what that means for a market-wide perspective, you see some very real changes to the market that could happen from that type of thing.
Yeah, I really appreciate my colleagues' comments. And I think a good example of what's just been said is the announcement about the potential use of stablecoins and other digital assets as collateral for derivatives. So this is a very interesting use case and could potentially increase efficiencies, reduce cost, lead to instant settlement, improve credit, for example, and free up more capital for other uses. But there are still a lot of issues to work out. On the regulatory front, for example, interoperability and even conversion from stablecoin to USD, because then you would have a settlement mismatch. So one of the promises of settling on blockchain using stablecoins is almost instantaneous settlement, whereas you would still need to convert to US dollars or another currency at some point where you still have a longer settlement period. But as you mentioned, using stable coins 24/7 can allow the markets to function all the time. And this has great efficiencies and will increase the flow of capital. And I just wanted to go back briefly to the smart contract flaw because I was talking with a colleague of mine. We worked together on the memorialization of the mRNA technology on blockchain a few years ago. And I was asking how does it actually happen that an attacker would be able to, for example, steal money from Wormhole, for example, or steal digital assets, or the Bybit hack, I think is a good example where a cold wallet was actually penetrated and social engineering was used in that case. So in the first example, Wormhole, which is a decentralized finance bridge to convert digital assets, there was a flaw in the smart contract. And it's well known that this terrorist organization spent a long time studying the smart contract, found the flaw, and took advantage of it. Whereas in the second example, Bybit, the cold wallet was accessed using social engineering. So using some old techniques and some new ones too, there are new vectors for attack on the cybersecurity side. And these are all things that it sounds like all of you are working on and will continue to work on together.
Can I just layer on one point to this with respect to the cyber risk, which is very real? I guess my question probably geared more towards Manoj. Our regulatory system does not really directly regulate the service providers, the security service providers in our financial market system. They really serve as third-party service providers, and the SEC, CFTC, and our financial market regulators expect that the registrant has policies and procedures to be able to diligence and vet. It doesn't actually reach those entities. Given this risk, which I would say is heightened as compared to other processes, do we need new regulations or a rethinking of how we regulate? Because it should continue to sort of self-solving. How do we think about our existing regulatory structure regarding cyber risk and this entrant of cyber risk and how we solve for that?
That's a really good question because I think there is a mental model shift that would be required from regulators. Everyone talks about principles-based regulation. You want to regulate the activity and not the participant. I think that's all fine, but there's also this just a generic statement if you think about custody of digital assets. Well, whoever has the key is the custodian, and it's never really interrogated to think about, well, what does that mean at a technical level, and how do we properly apportion responsibility to the people with the keys or the people that may lose the keys. So even if you're not, I don't know if it means that you have to regulate the cybersecurity provider, but to really rethink the liability regimes at least to create the proper incentives to ensure that even heightened diligence is done. Because to Rajeev's point, the consequences can be catastrophic if you lose your keys. Right? It's much easier to lose value in this space, and you really need to think about creating the right incentives to make sure that everyone is diligenced and held accountable.
And just to add, I don't think we've even figured that out for digital value today in terms, for example, our data, right?
Yeah.
Companies lose our data all the time. Doesn't seem to, we haven't figured out a solution for something as simple as that. And that's not even keys related, right? That's just as simple as storing data properly. So yeah, we still have a little bit of ways to go. But I just want to bring back to the earlier point about, we talk about tokenization, the benefits, right? Like the settlement on the weekend, for example, as starting to be practical. I do want to emphasize that it is practical and applicable and live today, right? Like, for example, we, as an exchange, we settle with our clients 24/7. We support assets, traditional assets like Franklin Templeton's Benji money market fund on chain, BlackRock and their BITO fund, and stablecoins, obviously. So I think a lot of these benefits are already being showcased in real life today in sort of a global context and crypto market context, but they're now starting to bleed into the traditional world as we bring on traditional collateral and financial assets and sort of merge these two sort of the infrastructure between these two ecosystems. So it's very fascinating to see.
Can I add to what Manoj said earlier, and actually Jason touched upon it, is from a risk perspective, they talked about the benefits, and so I'll just wear the risk hat here. It's important to understand that when we receive information to rate a new asset, digital or non-digital, we get reps and warranties from the issuer. And the digital assets in some cases, they clearly mention it's same CUSIP, same rights. It's very important for us to understand the difference between that, because that's not the case in true sense all the time. Because when it's a conventional asset, all investors have the same right should the asset default, but that may not be the case with the tokenized version of the same collateral which is being assessed or rated. And it's important from the asset representation risk perspective to understand if that token is carrying the exact same rights that they're promising the actually underlying collateral, because the investors are then carrying the risk of not being paid in full should there be a default of any kind. And that's one important aspect that also needs to be addressed. And to Jason's point about OKX offering trading and settlement, from Moody's perspective, we give very high importance and differentiate between, I think that's probably also pertaining to the first question you asked, between real and aspirational aspect, right? So we strongly track and try to look for scale, standardization, and integration with the legacy market infrastructure. It's very important to understand where the integration points of this innovation technology is going to actually be with the legacy infrastructure, because to my earlier point, you're now adding a new layer of technology which is unknown to a lot of people, especially within our own institutions as well. It's a small group of team that is devoted to this, but the rest of the organization is doing the BAU work, and they are not close to digital assets as we are. So it's important to understand how that may have any impact on the nature of the businesses changing and the markets changing, because that will impact a BAU in the long run. So it's the culture mindset of the market, and then like we were discussing before the panel, it's also cultural mindset of your own institution and company, where you have to bring them up to speed as to what's happening, how things are changing, and how innovative solutions are needed, not only on the technology side, but also on the legal compliance, risk management, your models, methodologies, everything needs to have an innovative solution or innovative minds running that solution. And I think that's the change that we will potentially see.
I think it's going back to your point about not necessarily having the same rights of a tokenized asset, and really understanding what the rights are that you have under that tokenized asset. If you take the stock, for instance, actually Commissioner Peirce made a statement regarding this, that if you really can't enforce against the issuer and you have synthetic rights as a holder, effectively, you don't actually have that security. You really have a security-based swap. And so, you need the regulator to be able to, or you need some form of regulatory clarity, which we know that they're working on regarding the security, so that the transfer agents are on board, right? I think Manoj and the Treasury Securities Project is quite unique in the sense that the banks themselves sort of serve as the official record keepers in Treasury securities. And you've got the right folks participating that actually hold the record for the Fed. But when it comes to public stock, you actually need the SEC to ensure that there is sort of that value chain goes down, and that the transfer agent is the one actually recording that change. Because absent that, I think you just have a synthetic right, and it's really a security-based swap.
I will note we had great legal advice on our project from that.
Yeah, just to give a really brief example that was in the news recently is the offering by Galaxy. So they actually did a tokenized equity offering, but they are the company, right? So the offering was equity in the token form versus someone saying, I'm going to sell you Apple stock in a tokenized form, and I will hold it in custody. And you have to take a hard look at the documentation and the reps and warranties, for example, and liability. And then also you want to have regulatory clarity. So that's two very different things. And I think part of that too is education for the users or the consumers or investors of those assets. People need to understand what they're investing in, and there needs to be a consolidated effort towards standardizing what's offered in the markets.
Yeah, absolutely. So we've got 1 minute left, and I want to throw the question out there for everyone to just quickly answer. In sort of preparing for this panel, I came upon some interesting projections regarding tokenization financial markets, where the projected range by 2030 really ranged from 2 to 3 trillion on a conservative basis to 10 to 16 trillion on a fairly bullish basis by 2030 would have tokenized assets in the financial markets. I think just given the conversation, there's obviously this value that we're really trying to unlock, but there's challenges and risks along the way. What's sort of the one roadblock that you think we need to overcome in order to even come close to those projections? I'll start with you.
Okay, thank you. That's a really poignant question. You got right to the heart of it. And there are so many things that are essential for us to work on, think about, unpack as we think about pushing forward on tokenization. But I'm actually, I'm a lawyer and a former trader myself, but I'm going to pick a non-finance, non-legal issue, which is what you mentioned, Manoj, which is culture. When you think about the vendor relationships that you have, or your custodial arrangement, or the banks that you work with, having a cultural fit with your firm is very important for the technical integration. And also, when you do identify those vectors of vulnerability, or if there is a cyber attack or some other nefarious activity taking place, you want to be working with partners who are really going to support you and partner and view you as a priority versus it's merely a third-party relationship. And I think that's an important point in the digital asset space that a lot of people don't necessarily think about. Yeah, that's right.
So I think I'm on the bullish side of those numbers. I think it will be on the higher end, but I think the big roadblock is regulatory clarity, like you said, Yvette, on making clear to the market the difference between a true on-chain instrument versus some sort of synthetic token. And I think if that confusion persists, that's going to be a big impediment to adoption, because a lot of people are going to get burned by buying the wrong thing and not realizing it.
I think I would talk about regulatory fragmentation, which I think the clarity would solve. Regulatory clarity would solve, not the Clarity Act per se, but it would. Of course, interoperability between blockchains and legacy infrastructure. I mentioned that earlier. Custody complexity, which is a major risk today that we see. And I think one important aspect is, which I don't think we touched upon, is the missing secondary market liquidity. Today, there are no secondary markets for digital assets. So even if you keep issuing, you need that secondary markets for it to be then consumed and then build those markets there as well. So I think those are the aspects that need to be addressed for us to reach a conservative or the higher end of the number, and that vision of on-chain capital markets is a few years away and all of these issues and standardization, everything needs to be solved for us to get there.
Just quickly, and tying it back to sort of the point of this panel here at the UN General Assembly, and it's for good, right? Like, the whole point of this is increasing access. Today, already, stablecoins do that. I think that's the most important point to take away for all of us. And the barrier to doing that is actually, we don't believe that digital assets actually have value. That's the issue. Most of us, I can wager, don't hold digital assets in their phone or in their wallet today. And we don't trust that it's the same as a dollar or something like that. We're seeing that globally happening as we speak. And as that progresses, that cultural shift of owning digital assets, that's the breakthrough that we will need.
Awesome. Thank you, everyone. Let's round of